Let me quickly bring in YeeFarn Phua, Director of S&P Global Ratings, joining us live from Singapore. Good evening from India and welcome to NDTV Profit. Thanks so much for joining us. We're looking at the rating and the fiscal outlook. This is a big rating coming in for India. So give us a sense of what specific fiscal milestones or policy reforms is S&P monitoring for this upgrade in India's sovereign rating.
Hi, good evening. Thanks for having me. Yeah, there were a few factors that we were looking at when we decided to act on the positive outlook and upgrade the ratings. The first thing, as we mentioned earlier, was really the government's demonstrated commitment to fiscal consolidation. The second factor that we were looking at was also the fact that nominal GDP growth continues to be very healthy in India. And this healthy GDP growth is actually helping to steady a lot of the credit metrics, especially given the fact that, despite the fact that there is some fiscal consolidation, deficits are declining, but it's declining at a very slow level. So this fast GDP growth has helped to stabilize the debt level of the government, at the same time also to gradually bring it down. The third factor that we saw was very important was the monetary policy settings and its development, how inflation has been controlled at a much durable rate over in recent years, and that we think speaks forth to the increasing strengthening transmission mechanism from the RBI.
All right, so thank you so much for taking time out to join us. I do want to quickly add on to that question and understand a little bit more. Now, for the longest time, credit rating agencies, including S&P, of course, has held back on a rating upgrade on concerns regarding India's central as well as aggregate debt. So what is your current view on that? We do see some fiscal consolidation and consequently some debt reduction as well. But what are the estimates you are looking at? How reasonable are these? Would you rather see debt consolidation taking place at a faster pace?
Pallavi, thank you for that question. I think you hit the nail right on the head. That's actually, in our statement where we talk about future upside movement is really even faster pace of fiscal consolidation. If we look at India's overall fiscal picture, for us, we look at it from a general government perspective, which is central plus the state governments. Now, as you can see, the central governments, in terms of deficit declining, actually has been quite fast. Right, during COVID, deficits were as high as 9.6. I recall at the peak of COVID. And back then, the finance minister was already very clear to say that within 5 years, we'll bring the deficit at the central level to below 4.5. And they certainly achieved that. On the other hand, the state governments themselves, the deficit has been coming down a lot slower, or perhaps even staying at almost the same level, between 2.8 to 3% of deficit GDP every year. So I believe that going forward, yes, the central government will continue to put in a lot of effort to consolidate its spending. But at the same time, I think the state governments perhaps will have to also chip in to help the overall deficit get smaller as well. But deficits aside, the other thing to really take note of is that sometimes it's not just the deficit that matters, but also the quality of the government spending. And that we see has been improving in the last 10 years. Increasingly, the budget has been tilting more and more towards infrastructure spend. And as a share of budget, subsidy also has been coming down. Now, that's very important because as your infrastructure improves, as your connectivity on the ground improves, that actually allows India to grow at a faster pace than what it is right now. So we are recognizing the fact that this is still an emerging economy where spending has to be done to support the economy, to also build infrastructure. But this all we believe that has a positive impact on India's metrics going forward.
Okay, Yee, I'm going to actually address the elephant in the room, and of course in every newsroom at this point of time, which is the global volatility around the tariffs. And I think in the past you have noted that US tariffs on Indian goods will have limited impact due to India's domestic demand orientation. What sectors or metrics would you monitor for any negative surprises if trade tensions escalate further?
Thank you for that question. I think I think overall, our view is that India's, as we said earlier, it's not a very export-oriented or export-reliant economy for its growth. A lot of India growth, I believe, around 60% or so drives from domestic consumption, and therefore, we do think that the tariff story will have limited impact on India's growth, right? As we see right now, India's export to the US is about 2% of its GDP. But once you factor in the sectorial exemptions on certain products like pharmaceuticals and also consumer electronics, their exposure is down to about 1%. So that's the reason why we feel that the tariff, even though it could have some impact, but it will be quite manageable. And overall, the long-term growth story for India remains quite healthy.
Okay, I do want to add on to that. While you have explicitly detailed, even in the report and in your comments, that the tariffs are not expected to have any detrimental impact as such on the long-term growth prospects. Back here in India, we do have some concerns regarding the impact the volatility and global uncertainty is having on investments which have already been fairly stagnant despite the government's bid to push up the number, especially in the private sector. That, alongside the fact that we have seen demand, especially in urban areas, remain fairly lukewarm. What are you making of these mixed sort of trends domestically, and how concerned would you be regarding those as well?
Yeah, thanks for that question. I think it's very important to have a sense of relativity here and comparison to India and its peers, right? If you look at a growth number of 6.5% for this year, this clearly puts India in terms of growth compared to other emerging economies as a clear outlier. It probably ranks, top few in the world in terms of its actual growth momentum. And I think that's very key for us. Of course, there could be some divergence in the economy, as you put it. Urban sector is perhaps not growing as quickly, but a lot of the growth is rural and so forth. But if you actually look into the detailed numbers of FDI inflows, especially last calendar year, even though net FDI numbers doesn't look so great, but actually net gross inflow actually continues to be very strong. Coming into sectors like services, into financial services, consulting, IT. We see a lot of that still keeps coming in. I think that certainly speaks to the fact that investors still have a lot of confidence in India as an attractive investment destination, especially the fact that you have a very large domestic market, and also the fact that the middle class is getting larger and larger. So all these are factors for investors to look at India and to come in to invest in various industries.
And Yee, our last question before we let you go, and thanks so much once again for your time. What's the one metric you'll be watching most closely for India in the next fiscal year?
Right. Yeah, great question. I think actually we pointed it out in our outlook statement. It will probably be the deficit that we are watching out for, how quick the pace of consolidation is. One thing also we're also watching out for is the Pay Commission's recommendations to see how what kind of deficit level we're going to be talking about, recommended by the Finance Commission, and also in terms of its recommendations to states and also to central government in terms of the revenue sharing arrangements and things like that. So we'll all be watching out for that as well. But in our outlook statement, I think we put very clearly that future potential upwards will continue to rely on, will be dependent on India being able to keep up its fiscal consolidation efforts, continuing to focus on its infrastructure investments, also at the same time, having a very conducive monetary policy environment and having inflation being kept under control as well.
Right. YeeFarn Phua, thank you so much for your time and for actually breaking that down for us so comprehensively. We'll continue tracking this and can keep coming to you for all of your insight and analysis.